Okay, excellent. And I got this cool over the shoulder graphic thing going on. So I'm trying to get better at these video calls, just advancing the technology here. All right, so today is September 12th, and hope everyone's doing great. It's certainly it was an awesome summer for me and my family. We did a whole bunch of fun stuff. Now fall is in full swing, and all of the activities have started back up, and so it's a really fun, awesome time. But I'm really excited to be talking to you guys about what's going on in the economy right now because there's a lot going on. And so there's a lot to talk about. The last time we met, I think was back in March was the last time I did this. So it's been a handful of months. And though I do try to do these calls regularly, I do save them from when I really have something to say. Because I want you guys to know that when I schedule these, it's because I really have something important to talk about. So let's get into it. Okay, the economy is slowing, but, all right, and in honor of my kids who love butt jokes, I will tell you it's a very big, very powerful but. Okay, so and why is the economy slowing? Well, we're pretty sure that the economy is slowing based on the economic data that is rolling in. It's really hard to know exactly where we are in the cycle all the time. It's always hard to know where we are in the cycle. The best we can do is use the data available to us to try and figure out, okay, where do we think we are today? Where were we 6 or 12 months ago? And where might we be headed, right? And we use different economic data to try and figure that out. I sort of liken it to, like the Boy Scouts. Some of you guys saw my LinkedIn post that I'm an official approved merit badge counselor for Boy Scouts, helping them get their personal management badge, which is sort of like a financial literacy badge, but it is one of the required merit badges to become an Eagle Scout. So I'm very happy to be helping the Boy Scouts do that. But that's sort of off topic. The reason, figuring out where you are in the economic cycle has anything to do with Boy Scouts is, when you're a Boy Scout and you're on a hike, you need to learn how to triangulate your position. And in order to triangulate your position, you need 3 points. Okay. You need to know where you were, where you're going, and then you need some point of reference. Okay. And so that's sort of like what we do with the economy. Okay. We try to figure out as best we can where we were. All right. And one of the really good measures of figuring out where we were is GDP data and jobs reports. Okay. Now, jobs reports, though, they come in lots of different flavors because we get jobs reports every single month. But the most accurate jobs report is the payroll data. The problem with the payroll data is it comes like 12 months afterwards. Okay, so we don't actually get the most accurate payroll data until we're already 12 months behind. And that was one of the big headline news items this week was, oh my God, huge payroll revision of 900,000 jobs. Did everybody hear about that? Okay, big, big, big news. Okay, the problem is that tells us what happened almost a full year ago. Okay, so that's like where we were. That helps to point out kind of where we were, right? And then some of the information about where we're headed, some of the information we get about that is with survey data, okay? Because you can't like automatically know based on every point of measure in the economy where you're going. The best you can do is survey people's sentiment. How are they feeling about things? How are entrepreneurs feeling about investment in their companies? How are people feeling about their spending? Okay, and that kind of helps us see where we might be going. But that's incredibly unreliable because it's all based on feelings, how we're feeling, how we think we're going to do, right? And we all know people fill out surveys incorrectly all the time, right? And so then we use other data called coincident data, which helps us understand kind of where we are, right? And that's a lot of the economic data that comes out that we try to pay the most attention to because it's this good mix of sort of timely and somewhat reliable. And so when we combine, backward-looking data with forward-looking data with coincident data, that's how we try to figure out where in the economic cycle might we be. Okay, so based on all of that is how I come to the conclusion that I think the economy is slowing, but, okay, but, the big but. Okay. All right. So before I get into the economy, let's talk about the stock market. Okay. Because the stock market is one of those leading indicators that tells us where might the economy be going. Okay. Because the stock market is very future looking. It's not so much concerned about what are profits for companies today. It's concerned with what are profits for companies likely to be into the future. So what you see here over my shoulder is a chart of the S&P 500 so far in this most recent bull market. Okay. The bull market that we're in right now, bull meaning upward, right? Upward market, started about 3 years ago in October of 2022. That was the beginning of this bull market. Okay. And along the way, about 12 months into the bull market, we had our first correction, right? Which is a temporary drop in the stock market. And that correction was in the summer of 2023, and we saw the stock market drop about 12%. Okay. Then almost a year later, we had what kind of was a correction, but not really because it didn't last long enough. But it was a very quick emotional, it felt like a correction because it was a very emotional movement in the stock market. It was dramatic, it was fast, it was far. And that happened in the summer of 2024, okay, where we saw the drop in the stock market. And I'm calling it kind of a correction, but not really because it didn't quite fit the definition of a correction. Okay. And then we had this year's correction, which of course everybody remembers because it's fresh on our minds, right? At the beginning of this year, we saw the stock market drop about 16% and then it recovered. Okay. And all through that correction, I was saying this is not the beginning of a recession. This is just a correction. We need to stay the course. And a matter of fact, if you're sitting on cash, buy the dip, right? Buy low, buy low, buy low, buy low. Okay. Well, that correction ended and we moved on and we continued to grow to the point that we are at today, where the stock market is at all-time highs. Okay. So let's keep going. All right, I'm just going to pause for a second because I realized I forgot to mute everybody. So I'm going to try and do that. Okay. I think we're good. Okay. Whoops. Go back. All right. So transitioning now from the stock market to the economy. Okay. These are, if for any of you guys who were on my presentation back in March, this is almost the same set of slides I showed you back in March, but I thought it was worth reminding. Okay. What is the economy? Well, the economy is not the stock market. The economy is not the president. The economy is none of those things. The economy is an accumulation, right, of all of the entrepreneurs running businesses in the United States and around the globe. Okay. And and it all starts with an entrepreneur, right? This entrepreneur brings together, okay, capital, they bring together workers, and they bring together resources, okay, to create a profit. Okay. And that system operates in any country, but here in this country specifically, within the framework, that triangle, within the framework of monetary policy, taxes and trade policy, and laws and regulations. Okay. There's also other things in in that triangle, but we're going to focus on those, right? Okay. And so as long as all of those things are working correctly, entrepreneurs can create profit and the economy can grow. All right. And as Village Wealth Advisors investors, right? As people who own portfolios that we're managing, right? You participate in this economic system. All right. Some of you guys participate because you work a job or you own a business. But when it comes to Village Wealth Advisors, you participate in this system through that capital piece of the system. Okay. You own stocks and bonds, and that's how you contribute capital to our economic system. And then as a reward for you contributing capital to the economic system, when entrepreneurs are able to make profits, you get to share in that profit. And as those profits grow, you get to share in that profit growth. And that's what we call returns. That's what portfolio returns are. Okay. You also, as part of your Village Wealth Advisors portfolio, have you contribute towards the resources that go into that economic system, okay? Because you guys own shares in commercial real estate and you own shares of commodities, which are raw resources, right? Raw goods that go into this system, okay? So again, as that economic system works, you get to share in the rewards because your stocks and bonds go up, your real estate and your commodities go up. All right. So that's when the system is working. Okay. However, of course, sometimes the system doesn't work perfectly, right? And when it starts working less efficiently, we have corrections in the stock market. And when it stops working a whole lot, we have recessions in the economy. Okay. And as I showed you back in March, one of the things we were dealing with was there was a whole lot of uncertainty around all of these different areas, right? How long will this trade war last, right? These trade, negotiations and back and forth and barriers that are being thrown up. What will happen to corporate taxes? Well, we did get an answer to that, right? The big beautiful bill was passed at the beginning of the summer, and at least now we know what corporate tax rates are going to be for a while. Okay. Supply chains, those are still very much up in the air. Okay. But I think largely because of the experience of going through COVID, entrepreneurs are now have much more information and are much more able to rapidly change their supply chains because they're having to do that. Okay. All of these new trade, war issues and these tariffs are causing entrepreneurs to have to redo their supply chains. And frankly, they've been able to do it much faster than I thought they were going to be able to. And again, I think that probably has to do with the experience of going through COVID when they all had to learn to do that just 5 years ago. Okay, the Fed, that's the big story of the day. The Fed is going to start lowering interest rates next week. Okay, and I think they're going to continue doing that for about the next 18 months or so. But we'll get into that a little bit more. Okay, but then the other thing affecting the way this entrepreneurial triangle works is all of the uncertainty, okay, which I graphed as clouds, sort of muddying the waters, making it hard to see what's to come. And there is still a lot of that, though some of this has started to clear up a little bit. Also, we've kind of gotten used to some of this, right? It's like, oh, gosh, it's really hard to see. I don't know. It's very chaotic. There's a lot of uncertainty, but we all kind of tend to get used to those things and then go back to making decisions like we were before. And that's sort of what we're seeing entrepreneurs do. They're kind of getting used to it and they're going back to making decisions. They might not be able to make those decisions as well as they could have if there wasn't so much uncertainty, but they're back to making decisions again. Okay. All right. So where are we in the economic cycle? Okay. Well, we're probably right about here. We're probably right about at the midpoint. Okay. We all know that the economy goes in cycles. Okay. There's an expansionary part of the cycle, and then there's a recessionary part of the cycle, and then there's the recovery. Okay. What complicates this normal cycle is the fact that we've had two very, very strange disruptions to the normal economic cycle over the past couple decades. We had the Great Recession in 2008, and then we had COVID in 2020. Okay, both of those were very, very, very unusual disruptions to what is a normal economic cycle. And so it's actually kind of hard to tell where this most recent cycle began. Do we say it began after COVID, or do we say COVID was just a black swan event, and so we just kind of exclude COVID from the cycle, and we say, okay, the cycle actually began way back after the Great Recession, right? How do we measure that? Okay. Regardless of those sort of very, very, very difficult to answer questions, I think it is most likely we are not at the end of this expansionary period. I think we're still somewhere in the midway. We still have room to go. Okay. All right. Now, let's try to all get on the same page about something. Okay. Because what we're all worried about is that there's going to be a recession. If you are worried right now, that is what you are worried about. You're worried that there's either going to be a recession or a total economic collapse. Okay. And so I at least want to get on the same page that one, if there's a recession, that is a manageable problem that we can deal with. Okay. And that if you're worried about there's going to be a complete economic collapse, I probably can't help you. Okay, so let's go through the why behind that. All right. So capitalism has always grown our economy over time. And what you're looking at here is a chart of our gross domestic product, which is a measure of how big our economy is, right? Since as far back as that goes, which I guess goes out, back to about the 40s on this chart here. Okay. And what I did was I just went back to the last four doublings of our economy. Okay. The last four. Our economy has doubled way more than four times, but the measurements start getting so small when you go back beyond the 70s that it just becomes silly to graph. Okay. So you can see one doubling occurred when our economy went from about 2 trillion to about 4 trillion. And that took about 8 years between 1977 and about 1985. Okay. The economy doubled in size over that 8 year period, 2 trillion to 4 trillion. And there were probably a lot of people at that time that said, $4 trillion, that number is so big, there's no way this economy could possibly grow anymore. Okay. Until, of course, it did. And the economy then doubled over the next 12 years from about 1985 until about 1997 or so. Took about 12 years, but then it doubled in size again. It went from 4 trillion to 8 trillion. And of course, there were people, in 1987 that said, or 1985 that said, this is ridiculous. This economy is so big, there's no way it could possibly double from here. Like it must be capped out, right? The numbers are just too big. They're inconceivable, right? Until, of course, it doubled again. Okay. It took about 17 years this time because of the financial crisis. But between about 1997 and about 2012 or so, the economy doubled in size again. It did it, doubled in size again, right? From 8 trillion to 16 trillion, which was about a 4% growth rate during that period. Again, greatly hampered by the Great Recession. Okay. And now we're in another doubling period where we're going from about 16 trillion all the way up on our way to about 32 trillion. Okay. We're about 13 years into that so far. We're not quite there to 32 trillion, but we will hit it. Okay. And when we hit it, we will just continue going on to 64 trillion and then to 128 trillion and then to 250 trillion. And eventually we will hit a quadrillion dollar economy. Okay. There is no cap. Okay. And the whole point of this growth of this chart is to convince you that there is no cap. Even though the numbers are incredibly large and really hard to wrap your mind around, they've always been incredibly hard and really hard to wrap your mind around. It's all just relative. Okay. And why does an economy, or how can an economy just continue to double and double and double and double? Well, it's really four components. It's population growth. Okay. As there's more people, there's more work that can be done and more things that can be done, right? Productivity growth, right? As one person can do more and more things in the same 8 hour day, it grows our economy and grows our standards of living, right? Infrastructure. Once a freeway is built, it's there, right? And we get to use it for generations, right? Once we lay fiber optic cable, right, from one, side of the continent to the other, it's there forever, hypothetically, right? And we get to continue using that forever, right? And so infrastructure projects continue, growing the economy in perpetuity. And then lastly, and maybe the biggest one, is innovation, right? Innovation, right? As we invent new ways of doing things, right? That makes all of those other areas, more powerful. Okay. All right. So again, I want you to look at this chart and realize every single one of those gray lines that you see going up and down, each one of those is a recession. Okay. And each one of those was a dip in that economic cycle. Okay. And as you can see, in the grand scheme of things, it's barely a blip, right? It's barely a blip in the grand scheme of things. Yes, in the moment, it was painful, it was scary, but the economy just kept growing, right? And it kept growing because of the population growth and the innovation and the productivity and all of that stuff we just talked about. Okay. So, okay, if you truly believe in your heart of hearts, okay, that Trump is going to permanently shrink our economy, okay, and that population growth and productivity growth and infrastructure and innovation are going to be completely destroyed, okay, and that our economy is now going to dip negative permanently. Okay, I just can't help you, right? We can't move forward from here. We have to at least have faith that capitalism will continue to work. And even if you absolutely hate Trump with every fiber of your being, okay, he's probably not going to permanently ruin our economy forever. Again, I want to move forward at least, putting that possibility aside. Okay, so again, let's get back to it. The economy is slowing, but let's talk about that but. All right. Okay. The Fed is about to lower interest rates, right? Which is not just a free lunch, right? It has both good parts and bad parts. And it's those bad parts that probably we have to worry about the most. But it is important to understand the good parts, okay? When the Fed lowers interest rates, it's going to take what is a slowing economy and it's going to give it like a steroid shot. Okay. And it's going to give it a steroid shot by activating more activity in the economy. And that is going to continue our economic growth for at least, I think, the next 2 to 3 years into the future. Okay. Why? Because lowering interest rates lowers borrowing costs for both businesses and consumers. Okay. It encourages businesses to invest, expand, and hire. It also encourages more spending over saving because, if you're only getting 1% savings account, you might not be that worried about, keeping the money in that savings account versus if you're getting 5 or 6% in that savings account, you might be more encouraged to keep more money in that savings account, right? So it encourages spending over savings, whether that's a good or bad thing, overall. And then it does reduce the value of the US dollar, which does encourage exports. Okay. All right. Now, on the flip side, there is a price to pay, okay, for lower interest rates. And that is number one, it can lead to inflation. All right. That's exactly the price we paid in 2022 after we had over a decade of historically low interest rates. It led to runaway inflation in 2022, which is why and how we ended up with the interest rates we have today. The Fed had to battle that inflation by dramatically increasing interest rates faster than we've ever seen them do in history. Okay. Also, imported products, when you lower interest rates and when the value of the US dollar drops, imports become more expensive. Okay. We've already seen imports become more expensive because of tariffs. They're probably going to become even more expensive as the US dollar drops in value. Okay. So that's going to hit all of our standard of living eventually. Okay. It's not an immediate thing, but it is going to start to hit all of our spending power and all of our standards of living eventually. Also, bonds and savings accounts pay less. All right. That's a consequence. And finally, debt levels do tend to rise with lower interest rates because of the borrowing it encourages. All right. So those are all of the consequences we're going to have to deal with as interest rates drop. Okay. All right. So in honor of the other but, okay, the other but is AI. Okay. And AI has the ability to dramatically grow our economy over the next 5 to 10 years. Okay. There are ways it will change our economy that we can't even guess at yet. And in honor of the way that AI is changing our economy, this slide is the only slide in the deck that was solely created using AI. And I actually think it kind of sucks. But anyway, it's kind of a boring slide. But I thought it was appropriate to use AI to create the slide about AI. Um, but truly, I mean, we are already integrating AI significantly into our own firm, and we are a drop in the bucket. The largest tech companies in the world, but especially in the US here, are pouring hundreds of billions of dollars into AI development, okay? Which is a significant amount of business investment, okay? Unfortunately, they're doing it many times at the sake of jobs. Okay, they're firing people and instead deploying those resources towards AI development. Okay, but that will lead to significant job creation down the road as a byproduct of using AI. Already, anecdotally, I was just on the phone with a consulting firm 2 weeks ago, asking them, hey, what would you charge to come into our firm and figure out how to make AI work and work better? And they said, sure, we'd be happy to do that for a $20,000 consulting fee. There's a job that did not exist even a year ago, right? Okay. So those jobs are going to start popping up, and more companies like ours and millions of others are going to be using it, and it is going to make business grow. Okay. All right, let's keep going. All right. So again, the economy is slowing, but your portfolio returns have been outstanding. Okay. And I know you guys are all thrilled about that. And I want to just take a second and go over it. Okay. Generally speaking, most of you guys have one of three portfolios with us, with some differences and customizations in between. But in general, you're either in the accumulation phase of life and you have our growth portfolio, you are about to retire or have recently retired and you're in our growth and income portfolio, or you are a much later retiree, or you just have a very conservative approach to investing, in which case you're probably in our income portfolio. And what you can see is to the far right of this chart, you can see what your returns are, roughly speaking, year to date, if you're in one of those three portfolios. Our most aggressive portfolio is up about 13% year to date. Our core retiree portfolio up about 11% year to date. And our most conservative portfolio up about 10% year to date. Those are not annualized numbers. Those are year to date actual returns. Meaning, if we keep up at this pace, which I'm not really sure we will, but if we keep up with this pace, we're looking at mid to high teens type of returns, which is great. And then in the column next to that, you can see what the cumulative return is so far in this bull market. Okay, it is very normal to almost double the size of a portfolio during a bull market. Okay, it's normal for that to get upwards of almost 100% return in a bull market cycle. That is not outside of the realm of possibility. Okay, so our growth clients are up about 57% in the last 3 years. Our early retirees, up about 50%, and our, income clients are up about 43% so far in this bull market that has lasted about 3 years so far. Okay, but not every year is like that. Okay. And I was just telling one of my clients, Lisa, who started with me about a year ago, who's like, oh my God, Jon, portfolio returns are incredible. You guys are magicians. And I'm like, yeah, but it's not like that every year. Like, welcome to the honeymoon year. There could be rough times ahead. Okay. And so what I've done was I went all the way back to 2017 and I just charted what our annual portfolio returns were each calendar year. Okay. And then across the horizontal of this chart is what we set as the target return for each of our kind of three core portfolios along the way. And what you see is most of the years, the actual returns are above the target, as is the case this year. But then every now and then, the actual returns are below the target, and not just below the target, they're in fact negative. Okay. The most recent year that we had negative returns was in 2022, which was the last bear market. It was a particularly bad bear market too. It was actually the worst year for a retiree portfolio. These are national stats, right? The worst year for a retiree portfolio It was like crazy. It was like in the last 6 decades or something like that. And that was because both bonds and stocks dropped at the same time. Okay. And so that year, 2022, our clients, really, regardless of what portfolio you were in, were down about 15, 16%. Okay. But you know, it never fails, right? Over a full cycle, if you wait long enough, you get some returns that are above the line, you get a handful of returns that are below the line, and in the end, you end up averaging those target returns that we tell you you can kind of expect and count on, right? So this is again, this is just reaffirming the fact that even though we're in a good part of the cycle, eventually negative returns will come, but have faith, hang in there, and you will end up at the average that we have promised. Okay, so what is the likelihood of continued growth? Okay, well, when we talked about 5 months ago, I told you I thought there was about a 70% chance that we had growth continue, into the foreseeable future, right? The next 3, 4 years, right? I've dropped down to about a 60% only because I thought by this time the trade war would be over and we would have seen the end of tariffs, which I really, really, really hate. Um, but they haven't. And I really hope they're not here to stay, but they're at least still here. Okay. And so because of that, I've dropped my confidence in continued growth from about 70% to about 60%. If we see the Fed act aggressively next week, like maybe a half of a percent cut, I think it'll probably go back up to 70. If we see a more measured quarter percent cut, I'll probably kind of keep my level of confidence at about 60% until we see things play out. Okay. It is very possible that we get multiple rate cuts before the end of this year, right? Um, and so that will affect my level of confidence. Okay, but my top concerns, right? Even though I'm 60% confidence growth will continue, it's not like there's nothing to worry about. There are plenty of things to worry about. There are always plenty of things to worry about. Right now, here are the things that I am most worried about. Okay. The Fed, even though I think they should cut interest rates and I think they will cut interest rates, I am concerned they're going to move too far, too fast, and too soon. Okay. And in no small part, and am I worried that's going to happen because of the politicization of the Fed, okay, and the political meddling in the Fed, which I absolutely hate. Okay. The Fed works much, 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 much better when they are independent of the political cycle. I don't care what party is meddling. Parties meddling in the Fed is not a good thing at all. Okay, because we just end up with monetary policy at the whims of the election cycle, and that did not work so well in Argentina, and it won't work well here. And let's just hope it doesn't happen. Okay. The other thing I'm worried about that tariffs are here to stay. Tariffs are not good economic policy, period. They are fine as a tool for negotiation, for diplomatic purposes, but we should not be using them as an economic tool. And it looks like the court is starting to strike that down because of that. And so let's just hope tariffs begin to go away sooner rather than later. Crypto collapse. Okay, this is something I never really cared about until this year, but I'll tell you why I'm starting to care about it. I always assumed crypto was going to collapse. The reason I assumed crypto was going to collapse is because it is not in our American best interest at all to encourage crypto. Okay. Matter of fact, I just assumed crypto would get to a certain size and then the federal government would go, okay, yeah, we're done with that. Delete. Okay. And they would simply disallow any more electronic transfers in crypto and crypto would go away. Okay. But for reasons that are just beyond belief to me, we have not only allowed crypto to continue growing, we have begun encouraging our institutions to hold crypto and begin to integrate it into our financial system. Okay. And so when it inevitably collapses, which I absolutely believe it will, I don't want it to be so deeply integrated into our system that it drags down our entire financial system. Okay. Quick stat that'll probably leave you a little bit unsettled. Okay. At the height of the subprime mortgage, well, before it was a crisis, at the height of using subprime mortgages in 2007, the total value of all subprime mortgages was about $4.5 trillion. Okay. And its collapse dragged down the entire global economy for about a decade. Okay. 4.5 trillion. The total value of all cryptocurrency today, 4 trillion. Okay. Pretty much the same size as all the subprime mortgages in 2007. Now, the big difference is our economy is about 8 times larger today than it was in 2007. So that stat is a little bit misleading, but still, it's huge. And we don't want it anywhere near our too big to fail institutions. And unfortunately, it is. So crypto collapse is a concern of mine. Finally, the risk of inflation. Inflation is not gone. Okay. It is much more under control than it was several years ago. It is not gone. And we do not want a loose monetary policy and a loose fiscal policy to have it come raging back. Okay. Now, all of that considered, all the good, all the bad, all the risks, I still, as I said before, think there's a 60% probability that the market continues growing throughout this year and probably for the next 2 years. I think there's at least 15 to 20% portfolio upside over the next 2 years. Okay, so that's additional upside in your portfolios over the next 2 years. I think that is reasonable. I think the Fed is very likely going to lower interest rates next week. It's almost a sure thing. And I think they continue lowering interest rates over the next 18 months. I just hope they don't do it too far, too fast. Okay. Long-term rates. I have not been a proponent for long-term rates coming down. I think long-term rates stay relatively high. Okay. And depending on how some of those big risks that I talked about play out, we might actually see long-term interest rates go up. Okay. If the world starts to view our fiscal house as not in order, we're not going to see long-term interest rates go down. We're going to see them go up. Okay. So in other words, if the Fed becomes politicized, okay, and they start willy-nilly lowering rates, you're not going to see long-term rates come down. You're going to see long-term rates go up because the world is going to judge our fiscal house to be not in order. All right. And that raises the risk associated with long-term bonds, which is what determines long-term mortgage rates. Okay. So I don't think mortgage rates are coming down very much, if at all. Okay. And in fact, could go up. Inflation, I think it's most likely going to stay low. I think the Fed is most likely going to be responsible with their interest rate cuts, and inflation's not going to get under control. And again, I think most likely GDP is going to remain positive, and we're not going to go into a recession. Okay, that's all my thoughts. So the economy is slowing, but all of that other stuff. So I can now open it up for questions for anybody who would like to ask. Oh, you can go ahead and unmute yourself if you do have a question.
Hey, John.
Hey, Rose, how are you?
Good, good. So on the topic of interest rates and mortgage rates not going down, but probably or maybe going up under the scenario that you painted, how does that affect the real estate market? And then how in turn does the real estate market affect the economy
Yeah, great.
in your view?
Yeah, great question. Okay, so the real estate market has been slowing recently, right? And it's tough to talk about the residential real estate market in general terms because the residential real estate market is so local. Okay, it really is. But if we are going to try and talk about it in general national terms, okay, the residential real estate market is slowing. The needle has just very recently shifted from a seller's market, which has been for a very, 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 very long time, to now a buyer's market. Okay, which means you can expect price reductions, you can expect negotiations, you can expect all of those things that we all called normal for decades until the insane low interest rate environment of the 2000s. Okay, so higher mortgage rates aren't going to help, right? One of the big problems is we've got a lot of people staying put in their homes because they're addicted to their low interest rate mortgage, which is totally rational, right? And I hear realtors tell me all the time, the only people selling are the people who have to sell because of death, because of divorce, or because of relocation. Otherwise, you're just not selling. Okay. And so if it plays out that long-term rates go up and mortgage rates go up, that's just going to get worse. Okay.
Thanks.
Other questions? Yeah, Barry,
John,
see your hand up.
yeah,
Go ahead.
I have two questions. First of all, the clouds you drew for us before, how you made them seem insignificant to a certain extent. That's why they were just clouds, but they feel a lot more significant. I'm a little concerned about that. Maybe it's just a feeling. The other thing is your projections are out for 2 years, and I know you can't go any further than that, but we're going to be involved in this hopefully for 20 more years. So what do we see happening, and what adjustments do you make when stuff happens in the opposite direction?
Yeah, so the irony is it's a whole lot easier for me to predict the next 20 years than it is for me to predict the next 2 years. Just like it's a whole lot easier to predict the next 2 years than it is to predict the next 2 weeks, right? The shorter the time frame, the more who knows what could happen, okay? But when we go out 2 decades, that's when we go back to that GDP chart that just keeps going up. When you look at 20 years, even something as significant as the Great Recession really just looks like a blip, right? It doesn't even matter so much. So, when you think about, well, gosh, where are we going to be 20 years from now? We'll probably be in an economy that is at least double, if not double and a half, the size that it is today. Okay. So don't even worry about the next 20 years. You're good. Things will very, very, very likely continue at that average expected return line that I showed you, right? Because over 20 years, we have enough time to average out all the humps along the way. Okay. And then when it comes to the next, 2 years, yeah, all of those clouds, unless they start to clear up, they're going to continue to affect decision making. Okay. If you think of decision making like an engine, we want decision making to be very, very efficient, right? We want every decision maker to be able to perfectly see all the pros and cons, perfectly weigh the cost of capital and the return on investment, and then make the perfect logical decision, right? That's the ideal. Well, of course, that's never the case. There's always things clouding our perfectly weighing of the options. But today there are a whole lot more clouds than we would consider normal. And for some of those clouds, they hit us emotionally more than others. I mean, some people in making a decision are extremely, emotionally impacted by the war in Ukraine. Others, it's not even on their radar, right? And so when we think about the clouds in both entrepreneurs' decision making, in consumers' decision making, and then in your personal decision making, right? When it comes to your personal decision making, that's where the one-on-one conversation becomes so important, right? Because we can talk about what clouds are clouding your vision specifically, and then kind of relate that to what are the clouds clouding in aggregate people's decisions, right? So I feel like that's an imperfect answer to your question, but I think I got as close as I can.
The last thing, John, is our country's national debt. How I didn't see that on anything. How concerned do we need to be about that?
Yeah, not
What do
much.
we do?
Yeah, not much. I have never been one who is too fearful of the debt, and I'm not really that way today. Um, you know it's not a big deal. It's not actually a big deal because people are still willing to lend us an unlimited amount of money at about 5%. Okay, which is the rate on long-term debt right now. Okay. Now, you'll know it's a problem if all of a sudden they're only willing to loan us money at 8%. That means everybody's aggregate perception of our risk, of the amount of debt we have, has gone way up, right? If if you're willing to lend money to me at 4% or 5%, you must think I'm a pretty good bet. But if you're gonna charge me 10 or 12%, that's like a hard money loan, right? So the interest rates, the long-term interest rates, which are set by the market, really tell us the global opinion about our debt. Okay. Now it's interesting. Rose had sent me an article about, the fact that we tend to ignore um, like big systematic threats to our system, and there are a lot of people of the opinion that our long-term debt is one of those cases. I don't really buy that argument. I think there are always systematic threats to the system and to our debt and to our economy. The thing is, most of the time they don't pan out, which is why most of the time the market completely discounts those risks. So I am not terribly concerned about the long-term debt. Um, I think it eats into our nation's cash flow, but it also reinvests into our nation's cash flow. Most of the people who own the national debt are right here in the United States. There's only about 20, I think the last chart I saw was 20% of our debt is held outside of the US. So most of those interest payments go right back into our economy. But yeah, if we see long-term interest rates spike, yeah, then there'll be a reason to be concerned. Okay, other questions? Yeah, yeah, I see you, Ken. Go ahead and unmute yourself.
Yeah, you keep hearing about the end of Social Security. What is your take on that?
I mean, I guess it could happen. All there's so many things that a year ago I would have said were impossible that today I have to concede that there's a possibility. I mean, I don't know. The voters' attitudes towards promises we've made in the past has swung dramatically. That pendulum has swung. Whereas before we were obsessed about, honoring the promises we've made to generations in the past, and today we seem much less. And so uh, I don't think you have anything to worry about. I don't think most of the people on this call have anything to worry about. But I can tell you, I'm not counting on it. So, when I'm counseling, people in their 40s and 30s, who still have, many decades before they can collect it, I'm telling them, listen, don't plan on collecting Social Security until you're in your 70s. I think it's most likely that we see the normal retirement age pushed to probably early 70s, and that would be kind of normal. And not terribly unhealthy. But I think for most people who are currently receiving Social Security, I think you're fine. Other
Hey,
questions?
John, it's Lisa D. I
Hey,
have a question for you. You talked a little bit about AI and you cited an example of, say, a consultant who goes into businesses and sort of advises them how to maximize this technology, and that's a new job that would be created. But are you worried at all that, AI is just growing so fast that so many jobs will be replaced? It's already starting to happen, that there will be just unimaginable amounts of people unemployed, which will kind of contract spending. Everyone will just sort of, have to hunker down because there just aren't going to be jobs. Are you worried about a scenario like that?
I mean, I have to concede that it's a possibility. I think that is highly unlikely. I mean, we've all seen so many times in the past, even if we go back 4 decades, where these same concerns have popped up, right?
Yep.
Computers, right? The
Yeah.
personal computer was going to, completely disrupt, and it totally did, right? It totally did. There are not many, personal secretaries anymore, right? Because we've got personal computers, right? There's no need to be rooms of, it was mostly women, right? Just typing on
Uh-huh.
typewriters. Okay, yeah, all those people got displaced. And so I think one thing that we know 100% is that there will be huge displacements of categories of employees. Okay. But what has always emerged, and I truly believe will emerge again is a whole new category of employees that we never
Yeah.
imagined could exist. I mean, look at all of the largest companies today, largest employers today didn't even exist 30 years ago,
Yeah.
right? Amazon, Microsoft, well,
Right.
and Apple existed, okay? But Amazon, Microsoft, Apple, Facebook, right? Nvidia, right? None of those even existed in the
Yeah.
early 90s. And now they're not only the
That's
largest
true.
corporations in the world, they're the largest employers in the world, right? So, I guess irrationally or not, I have faith that that'll probably just continue to work.
That makes sense. Thanks, John.
Yeah, no problem. Other questions? Okay. All right.
I
Well,
have,
everybody.
John,
Oh,
I have a kind of related question. Another thing I've read about is an AI tech bubble, as we have this super expensive infrastructure, and we have our president taking a big share in the ownership of a corporation that is deeply invested in AI, and we've got a major Chinese competitor in this area who is in at the moment throwing big hoops into showing a large language model that is more efficient and cheaper to run, getting much of the same benefits. And so what about a bubble where the US economy goes heavy into this enormous infrastructure and then it just doesn't pan out? And also, I've read about people like you are talking about we're bringing a $20,000 consultant in to show our company how we can best use AI. And a lot of like a really high percentage, it's like 9 out of 10 corporations that are small businesses that do that go, no, I don't think so. And it's like, it's not a super high percentage of corporations that are really finding that it's useful for them. So there's like, it seems like there's a inflationary thing going on here. So I'll mute myself and you can respond.
well, that's fair. I mean, if we think back to the dot-com bubble, right? I think it is reasonable to relate the two, right? In the late 90s, there was, to use Greenspan's phrase, irrational exuberance around how the internet was going to change the world. Okay, and as it often does, people's optimism got a little ahead of reality, right? And we had ridiculous amounts of investment and money being pumped into internet companies that disappeared overnight. Okay, and undoubtedly that will happen again, undoubtedly. But we still have the internet. The internet still changed the world. It just got a little ahead of itself. And then there was a reality check, and then over a decade, pretty much everybody adopted it, right? I mean, I remember the websites of companies, in the early 2000s. I mean, it was laughable. People were like, "Hey, I got a website, but it doesn't do anything. It doesn't tell anybody anything. Nobody really knew how to use it yet." It was awkward, kind of like you're saying, how 9 to 10 companies are like, "Well, we have AI, but we don't really know what to do with it," right? There's going to be that, typical technology adoption cycle. There's like the early I don't remember all the stages, right? There's the early adopters, and then there's the whatevers. We're gonna go through a cycle like that. No, undoubtedly, people are gonna lose billions of dollars on investments that go defunct, but I don't
So
think
how do we not be part of the people that lose billions of dollars going to fund? To bring it back to
yes.
what my question was really all about.
Ah, how am I not going to lose money, John? Right? That's really comes down to diversification. Okay, diversification, diversification, diversification. I want all of you guys to benefit from the doubling of the economy that will be helped by the implementation of AI. Okay, but I don't do any speculative investing in client portfolios. Okay, we don't do investing where we're going to bet that one of these companies AIs is going to be the one that wins, right? Because I think that has no place in your portfolio. But I am very comfortable investing in industries that I think will be able to grow profits based on the efficiencies that come from and the efficiencies and thus profitability that comes from AI. So I'm kind of betting more on AI benefiting the entire economy than I am betting on any particular AI being the dominant space, right? I mean, if we were in the 90s, we would have said Netscape was going to be the the biggest company in the whole world, right? And goodbye Netscape or Yahoo, right? Who still exists, but barely. Those were the biggest players, right, in the early stages. And inevitably they get outpaced. And so I'm not into making those bets. Okay, other questions? Any other questions? All right, great. Well, listen, everybody, thank you so much for your time and attention. I hope this was valuable. I hope you enjoyed it. Again, I will be blasting out this recording. Please send it to somebody who you think might benefit from this information. And if you have, friends or family members that you think should have a conversation with us, those introductions are wonderful. That is the best way for us to continue to grow and serve you guys better. And so we love meeting your friends and your family. So yeah, thank you so much, everybody. Take care and all the best.
Thank you, John.
Thank you, John.
Thanks,
Oh, my
John.
pleasure. My pleasure.